Hi, I'm Tom Cooper, sales manager here at Knight Knox, and I'm joined by Rebecca Jackson, associate director and serial property investor, and a good friend of ours, Damien Jordan, who set up DamienTalksMoney, one of the biggest, if not the biggest, UK financial YouTube channels in the country.
We've really rolled out the red carpet for this one.
Welcome.
Yeah, no pressure.
No pressure. So I thought it'd be a good place to start if you could tell or give everyone a bit of an idea of your background and how you came to be where you are at the moment.
Well, it all started here, didn't it?
Yeah,
did.
that's
This
it.
place. Yeah. So I used to work for Knight Knox, for context for people. So that was, I think we said 7-8 years ago, which is kind of crazy to think about, isn't it?
It's flown.
Yeah.
Yesterday.
But yeah, I mean, I'd worked in finance before that in roles, but yeah, I worked here and then I worked for an accountancy firm. But I started the YouTube channel during first lockdown and it went well.
Really well, yeah. I mean, you started it part-time first of all, didn't you,
Yeah.
before you took it on full-time?
Yeah.
How did the interest in finance start?
Oh, I've always had an interest in money since I was a kid, and I think in my early 20s I made a lot of mistakes financially, which probably led me to then seeking out what the right things to do were. Which
brings us purposely and perfectly onto what we're here to talk about today, which is mainly the potential pitfalls for investors. Rebecca, if you could give us an idea of kind of some of the financial missteps potentially that you may have made.
Gosh. Okay, so
broad place to start.
Yeah, so not only obviously I work here at Knight Knox and this is my profession, but I do actually have a passion for property, building a portfolio. So I started quite young, heavily influenced by family. That's always what we've done. But yeah, everything from rogue tenants to really not doing my homework on contracts through the legal process, things like that. So, you know, you find a property, you agree a deal, you're happy with the price, you've got your mortgage arranged, but maybe things around, you know, ground rent that I wasn't too educated on, and then you're lumbered with a lease that's probably not that appealing now when you look back. So I'd say that's, you know, really not doing my homework. I'd say is the main pitfall for me.
Have you ever bought anywhere you regret?
Have I ever bought anywhere I regret? Sometimes when you have a bad experience with a tenant, but then I think it goes through cycles. So sometimes, you know, you've got a really bad run, you could be inundated with maintenance issues or, you know, repairs or just sometimes just grief, just generally from all of them. And then all of a sudden there'll be 6 months will go by and you won't hear anything and everything will just be completely seamless. You know, rents are rising, you do a review, nobody argues that review. You know, it goes really well. So yeah, I think it goes through cycles. In answer to your question, probably yes. But I think the good thing about property is if you hold on to it long enough, it'll always come good, in my experience anyway.
I feel one of the common misconceptions, though, is from landlords is that it's going to be smooth sailing.
Correct.
They expect it just to get a rental payment every month.
Passive.
They'll be completely passive.
How often do we get passive?
I just want something where I'm too busy. I don't want to have to deal with something on a day-to-day basis. I buy property, it sits there. I get my rental come in, and that's it. I don't have to think about it. And really, it's not really like that, is it, Damien?
No.
No.
I don't think any investment is like that because there's no juice without a squeeze, right?
Yeah.
And I think property is probably a more active strategy in terms of you need to be more hands-on because there's humans involved in the sense of people paying the rent, things breaking that you need to repair. But even in the stock market, people will say, oh, I just want to buy it because I want 9% a year on average. What they don't understand is some years it's going to go down 20%. And can you handle that? You know, can you deal with yourself?
Yeah. Well, imagine if you could see the price of your house every single day.
Correct.
I think it'd drive most people crazy.
If someone shouted it at you as you walked out the door, you'd probably some days be like, I need to sell this place right now.
I'm down 10 grand today.
It's one of the benefits of property is it protects you because the market's not transparent in that way in terms of pricing. The stock market's live priced, which makes you feel like you should do something.
And you have access to it.
Yeah.
Now with every single trading 212, even Vanguard now, they're moving to an app-based system where you can see it live day to day.
Yeah.
Luckily, unless you're subscribed to Rightmove alerts, you're not going to get your property value every single day. Is there any particular...
And we do check those apps, don't we, daily? Like, even if you're not in the markets like Damien is, everybody does, and sometimes you do gulp, and then other days you're like, oh, right, yeah, this is
I think because we're in the property game, I think even just knowing what's coming for market in and around your area. It's almost like an obsession, isn't it? Just to see what's there, what's coming up. Can't help myself every day. Going back to just kind of financial missteps then, Damien, is there anything particular that, say, you, if you were talking to yourself 10 years ago, would tell yourself to do differently?
How long we got?
Well, about an hour, so keep it short.
Yeah. No, I think the first thing I'd tell myself to do is chill out, just to relax and to not rush, because I think you have a tendency to think if I don't do something right now, or if I need it now, and you kind of beat yourself up about lost time. And I think everyone thinks, I wish I'd started sooner, or I wish I'd done
so much pressure on yourself.
Yeah, chill out, because I think you rush and you make bad decisions.
I think that's part for the generation as it is now. I think delayed gratification isn't something that we know anymore.
We don't possess it.
You want instant results from everything, whether it's, I don't know, you go on a diet and you expect to lose 6 pounds the next week. If it doesn't, then you throw it out, start a different one. And I think it's the same with investing. I think that may be why the youth of today do look at things like the stock market or crypto, because they can see instant, not necessarily always wins, but instant returns in one way or another. They can see that gratification immediately.
Yeah, I mean, there's like confirmation bias in the sense of the people who make money quickly, we talk about it online, and the people who don't. So you think that people in crypto make loads of money. You see the tip of the iceberg. Yeah. It's like gamblers, right?
Yeah.
They tell you about their winnings.
Never about the losses.
Yeah. I think the other thing that kind of goes alongside that, chill out, is I would have a longer timeline in terms of how I was allocating my money and how long I thought it would work for me, say. As a youngster, I was probably obsessed with getting rich quick. And that takes you away from investment and leads you to speculation, to gambling. You'll start looking at things like trading, like day trading and Forex. You'll look at getting a HMO and filling it with 20 people. And things like this. You'll be like, rent to rent, HMO, no money down, let's go. Like these kind of strategies that actually aren't good. They're not investments. They're they're speculation. You're rolling the dice. Yeah. You're essentially gambling.
And if that's a fraction of your portfolio, fair enough. But obviously you speak quite a lot on your channel about where you put your investments. Obviously you don't recommend anything specific, but it's all broad ETFs, index funds. That's not speculation. That's just putting your money to one side, letting it accumulate, letting it do its thing. And then even if you're doing the bits on the side like the crypto or HMOs and things like that, then that forms a small part of the portfolio.
Yeah, you don't risk the kingdom for a pot of gold. You don't go like, I'm going to put 100% of everything into this speculative thing, hoping that it blows up. Because the one thing with crypto, as an example, I think it's a good example of speculation, is a lot of people say this thing's going to dominate, it's going to take over the world, it's going to change everything, so I'll stick everything I've got into it. Yeah. Well, if it does what you say it's going to do, if you've got 10% in, that'll be enough. Yeah. But the risk is that it doesn't do that and you've burnt your whole life. Yeah. So you've got to protect yourself in that sense. And I think one thing to consider with investing, which I think most people don't, is your whole portfolio. You are your portfolio. So rather than just be, I'm just property, I'm just stocks, which is the best? You view a bit of everything, and you know that long term you'll end up in a good place.
Well, I think most people that we speak to, on a daily basis, you will rarely find someone who's got one portfolio of just one type of asset. They're usually quite diversified, aren't they?
Definitely. And I think because of what we do as well, it's what we talk about all day. So we're naturally going to be attracted to property investment, aren't we? As in personally, for our own portfolios. But yeah, like the clients that we speak to, it's very broad. I mean, they all have a goal in mind. We've all got a goal in mind, haven't we? It's to make money. But yeah, they've got a broad portfolio. I think it is quite rare. You think, I'll only do property, or this is my very first time looking at property. I'm only in the stock market. They do want that mixture. And I think it's really important to have that mix now more than ever.
Well, it's working towards retirement, isn't it? Everyone's trying to make a passive income from one avenue or another so that they can retire with that golden pot. And it's how do you make that up now? Obviously, stocks and shares, property, bonds. I mean, obviously, when you're 20, 25, you're not really thinking as much on, the majority of people aren't thinking towards retirement, are they? I'd say probably it only starts when you get into your 30s, where people then start to think, actually, I need a plan here. Absolutely. How am I going to replace this income that I'm getting from my work? Pensions obviously have changed a lot over the last 20, 30 years. You can't rely on company pensions anymore. You now have to arrange and fend for yourself. Do you think a lot of investors have made mistakes along the way?
Yeah, I think the first mistake is not recognising the fact that everything will change.
Yeah.
Tax rules, legislation, the performance of certain investments. You obviously had the property boom of the last 20 years has been mental, right? And especially in certain areas like Manchester.
Yeah.
That could continue, it might not. So I think to be all in on one thing, or to say this has worked in the last 20 years so will continue to work, might expose you to changes. I mean, we've seen tax rules come in that have been quite harsh on certain types of property ownership. Yeah. So now like a limited company structure is more beneficial in a lot of ways. Yeah. The stock market as well. In the past it was like buy value businesses, buy, Procter & Gamble, and then the tech businesses have wiped the floor with them.
In the last 10, 15
years.
Yeah.
So I think, recency bias and thinking, this has worked for the last 4 years, so it will work going forwards, that's probably a mistake. And I think broad diversification, again, is a way of protecting against that.
I think when you're young as well, you said like when you're in your early 20s, let's face it, it's not sexy talking about pensions, is it? It's not like, where am I going to place this money? Do I really want to think about where I'll be at 55? In the same way, if you buy your property, that is exciting. It is quite sexy in a way, isn't it? But you're still, you're looking at those, and we'll chat about mortgages, but you're looking at those documents thinking, so this is over 25 years or 30 years, so I'm going to be 50 or I'm going to be 55 by the time this is either paid off or, I'm looking at another avenue. So I think the earlier you start looking at all these things and get educated about, the better. Massively.
I mean, like, just bring it back to your point, you buy a property, you've got keys, you can go and see it, it's tangible. Yeah. If you put that same amount of money into your SIP and you've got it there on a piece of paper, no one's telling me that a SIP is sexy.
Well, we had this conversation over lunch, didn't we? You were like, put some in your SIP, and you were like,
exactly. Even though financially that probably makes the best sense. Yeah. You're thinking, it's just not.
I actually said to Davey, I said, I'm looking at a few buy-to-lets, but it's the best part of X amount to put in, and then you've got to think about X, Y, and Z and tax. And he was like, well, yeah, but if you do this and put it into your pension, you'll get this. And I think I actually probably frowned at you.
Yawned. You did.
In fact, it's like when you speak to your financial advisor, they'll always say to put it into pensions.
Yeah, absolutely.
They will probably advise on certain things more than others. And again, it brings it back to the same point. You're like, but I know the property market and I can put it here. And I think there's the bias of your area.
Well, you guys, you can't be overexposed on expertise. So what I mean by that is you have insider knowledge that most people listening to this won't. As in, you see the market, you see deals come into the market. When people are like, should I buy whiskey as an investment? If you're a whiskey seller, yeah. But not if you're a random guy from,
Scotland.
Scotland. Anywhere, the Scottish know the whiskey, I'm pretty sure. But if you're from Scunthorpe and you've never drunk whiskey, you shouldn't be buying a barrel of whiskey. But for you to be like, I'm mostly in property, but you live and breathe it every day. Yeah. Most people are doctors or professionals that are thinking, how can I invest to the side, and I don't have that expertise knowledge. And I think that's probably the difference and why it might make sense for you to be more exposed to property.
I think a lot of our clients are in that position, the people who've done very well for themselves, very good jobs, business owners, high net worth individuals. They'll have a pot of money and they will go to experts in each field to say, right, what do I do with this, how do I do it? So you'll get doctors, for example, who've made a load of money, got a load of stocks and shares.
Hard-earned savings.
Exactly. And then you think, certainly when it comes to property, I say you'll know your area. You might know what the best prices around your area and what the properties rent for. But unless you happen to live in that area, which is giving necessarily the best returns or has got the best 5-year time horizon for capital appreciation, that might not be the best place to go.
It's crazy because, people will buy American businesses through the stock market. They'll go, I want the S&P 500 because I want Tesla and Facebook and Google, but I'm only going to invest in property 4 streets away from me because, I can't buy a house anywhere else.
I don't know it,
Yeah. That is so true.
Yeah.
So just bringing it back to pensions, as you were speaking before, because I was toying this before. So I've recently a new dad, 7-month-old, and I was like, right, I'm going to put some money away for her. I was like, do I put it into a junior ISA that they can access at 18? And you're like, yeah, I'm handing you a pot of cash to do with whatever, but you're 18 years old, and we've all been 18 years old, and that could go on anything.
I'm going to finance a car.
Yeah, exactly.
I'm going to do this.
Or do you lock it away in a junior pension, and then they're not going to see it for 60 years. I mean, chances are I'm not going to be here in 60 years to see when it comes around anyway. So it's a bit of a dilemma to say, well, what's the best thing to do? I mean, we're all in a position now, we've all got young children. Damien, you speak a lot on your channel about how you set up your son and teaching him along the way. How important do you think financial education is in investment?
I think it's massively important, and I think it doesn't exist, which means a lot of very highly competent people out there that do really technical jobs think that investing is this really complicated thing, because they're like, I'm a barrister and I don't understand it, so it must be like next level hard, but it's not. It's really simple. And I think if we can start from those early ages, that's great. I think so if we use the child example, because they, like, from a pension perspective, they have the longest amount of time, so they're tucking it away. The benefit of doing that is they benefit from compounding the most. If you stick £5,000 into a junior SIP when a child is born, and that compounds at the average rate of return of the stock market for 60 years, there'll be £1 million in there by the time they get 60, just from £5,000. You don't touch it. Inflation will have done a number on that, but the numbers are the numbers. At 35, they're going to wake up and go, holy crap, I need to save for my retirement, and you'll be able to go,
I've done it.
I've started. Now you can pay into it. And remember that 20 grand that you got from your junior ISA that you blew in, Zante and on a Peugeot 206. Don't do that again. Speaking from experience. I think that's an important way of teaching them. And I think the thing is, it's not that complicated, but the education system isn't set up. And I do think there's an element of, it doesn't matter if you teach a kid, they probably wouldn't listen.
No.
Because, you struggle to wrap your head around.
Interest in it at that time.
Imagine saying to a kid, if you took away 10% when you're 60, you might have a bit of money. They're like,
I mean, if they rephrased it and said, I'm going to make you a millionaire, if that was the name of the class that you were going into, you may have
paid more attention.
100%. I think I would.
But I think most people that are young we think that we're going to change the world, right? We think that we're going to be rock stars or whatever, and then there's a realisation later in life that maybe that isn't the case. And I just think, I do understand from an education perspective that it probably falls on deaf ears.
I've still got hopes of being a pro footballer.
Yeah.
I think I'm older than all of them now. But
Milner, mate. Milner. Tom's nickname was always Milner, wasn't it? Because he just had a steady Eddie, and he was
steady,
good.
7 out of 10 every time.
Yeah. So there's still a chance.
Still a chance.
So do you love pensions then, Tom?
I don't think anyone loves pensions, do they? I know that's a broad thing to say. But I've learned a lot. I mean, openly, obviously, we've been friends for a long time, since you used to work here, and I watch all of your videos as well as a lot of other UK finance YouTubers, because it's a learning process. I say 5-10 years ago, there was nothing, there's no education, the schools don't teach you anything. If you're not in a position where you're fortunate enough that maybe a parent or a guardian also teaches you about it, where do you find it from? Like, luckily now we do have social media and other avenues where you can learn it, but before that there was nothing. So I think I've learned a lot over the last 5 years, and now I'm in a position where I can then potentially help either family or the next generation. So if it wasn't for stuff like that, then I don't know how we would.
You still seek it out though. You kind of, as in you went and looked for the information. You might have been served a random video by me, and that might have got you in. But most people, they're kind of looking. There's a lot of people that don't even know that it exists.
Panic at 32, I was like, I need to retire in 20. I think it's when my dad retired at like 50 or something, and I was like, there's no way. I was like, I'm early 30s. Like, how are we going to do that at 50?
This is a key point, right? So people our age, they have to take ownership, because the generation before us had generous pensions and rode a property market that, we're not going to say. I think I was looking at it the other day. So if you bought a house in 1950, the gap, how that property's increased by 140 times from 1950 until today. So if in another 70 years for property to do the same, the average house would be worth £38 million. Jeez. So like this explosion that they rode over that time period was, for every pound they put in, they got 140 out.
Yeah, you probably should buy that buy to let.
Yeah. Good to go back to stick to pension.
They caught a good wave in terms of the defined benefit pension schemes. These people didn't even really know what they had, and then they get spat out, and it's like, oh, here's 30 grand a year for life, So whereas our generation, we have DC schemes that define contribution, which how much you get is defined by how much you contribute.
Yeah.
That's what it means. So you have to be actively involved
Yeah.
to have a good retirement.
If you've not got those influences, like you touched on, Tom, as well, like I said at the beginning, my parents were quite influential in terms of my property journey. And still are, really, and still are. We have difference of opinions on some parts, but, you know, they are there. But latterly, I'd probably say, probably in the past 8 years, I have paid more attention to other avenues. So I have looked at my pension, have looked at stocks and shares, ISAs. I've actively done that, you know, and spoke to people or taken advice. And, you know, again, Damien, I watch a lot of your stuff and it helps. I just said the other day, I was sat on the sofa with my husband watching one of Damien's videos, and he said, "What you watching?" And I turned it, and he went, I watched this video the other day, and he had no idea it was, you know, Damien and I were friends. So, you know, you like you said, you have to actively seek to get the information. It's not just handed to you now.
Mm-hmm. One point here we've mentioned a few times. How do you know when you're financially ready to invest? Quite a difficult question, really. I suppose some people would assume it's based on the finances, but in reality, that's not really the case, is it?
No, I think a good comparison is how do you know when you're ready to have a kid? And I think the answer is you never are. You just kind of got to do it.
Yeah.
Do you know what I mean?
Just hope for the best.
Yeah, just hope and pray. And I think with investing, people can always talk themselves out of it. When I worked here, there was constantly the main objection was, oh, but you know, Barry said that there's going to be a crash. So I'm just going to wait for that, and then I'll buy it at an even cheaper price.
Yeah,
and they never
we still get that.
Yeah.
That's probably one of the most common objections that people will have. So obviously, recently we've had cost of living crisis. Previously, it was the war in Ukraine. We had Brexit. There was COVID. So there's always been a reason for people not to put the money into the property market. There's very few signs. There's never an article in the paper saying now is the perfect time to put your money into property or stocks and shares, is there?
The best way to think about it is if something's increasing in price, so you buy it and then tomorrow it's worth more, why do you not want to buy it? Okay. If something's decreasing in price, so it's going on sale, why do you not want to buy it?
Good point.
You know, like if McDonald's suddenly go, the £2 burgers are now £1, you buy a burger. But with assets, people are like, oh, no, you know, they don't want to catch the falling knife, but they don't want to also buy it as it's getting expensive. So when are you actually going to buy it?
If all those people, and us, imagine if you'd bought more when we were all working together, or our clients
hindsight.
My biggest regret is not being in it.
A lot of people would have said when you worked here, that was like the peak of the market as well. I mean, the hype was all about Manchester, wasn't it, at the time, and the growth. But look where we are now. Look where the prices are now in Manchester.
I remember selling the apartments thinking there's so many apartments getting built. How are they going to rent? And now it's we need 10 times more than there already is.
There's 10, 15 inquiries for lettings for every single property that comes on the market. But it's quite ironic, really, that obviously when the property prices are supposed to be falling, or there's a recession looming, or whatever news that's out there, people are very quick to say, hold back, I'll hold my money because that's safe. At that point then, it's very, very difficult to commit mentally for a lot of people to say, right, I'm going to buy a property. This is the best time to buy now, trying to time the market. The same can't be said when prices are rising, when it's now a new all-time high in the stock market, when Tesla shares were going for however X amount. People had no problems then throwing money into that.
Yeah.
Why is that the case, you think?
People chase recent returns, and people think, again, what's happened recently will continue to happen. I think, you know, people's timelines just aren't long enough. And I think if you zoom out on most, so on property, if you take a view of 30 years, there has never been a bad time to buy in the UK. And the argument is, well, I would have bought at any of those prices because of where the market is right now. With stocks, I think it's similar. Individual companies is a whole different ball game. Yeah. Because that's like, you know, you're buying a business, an individual business. That's like, instead of going, I invest in commercial property, it's like, do you want to buy this corner shop on the corner of, do you know what I mean? You need to know what you're doing. You know, it's not like buying an apartment, you know, you're buying an individual company, essentially. I think people are just really bad.
Parting with the money.
Yeah, and also they're irrational. You know, irrational in the moment, especially when it comes to money. Yeah. And I think when it comes to things like the stock market, these are why these sayings exist. It's not timing the market, it's time in the market. As an example with the stock market, right? People all the time try to guess which way the stock market's going to go. But if you look at the last 20 years of stock market returns, if you missed just the best 10 days in the market, you'd have halved your returns. So just 10 days, because those 10 days go mental. So if you rode that whole 20-year period, just 10 individual days out of that, what's that? You know, it's like thousands of days, right? 7,000 days. And if you miss just 10 of them, you'd have half the returns. Most people are not good at identifying what those days are. So it's better for them just to get in and ride it. And I think the same with property, of going, do I expect in 30 years that property prices will be higher than they are now? The answer is yes, because inflation alone will drive up prices long term. So you just get in, you buy something good that you know will rent, that's in a good location, and you just ride it for 30 years. And if the price dips next year, oh well, buy another one. Get another one.
It's on sale.
Don't sit there kicking yourself, because in 30 years you'll look back and be like, I can't even remember what I bought that for, but all I know now is it makes me a load of money.
I think if you look at like the last property crash, if you look like 08, and we touched on this, didn't we, earlier, about how, you know, when there was 95% mortgages, 100% mortgages apparently as well. Like now, the amount of equity that you have to have in a property, if you're leveraging it anyway, you know, you're pretty safe. I think if you look at the trends over since that crash and before, if you've got at least 30% equity in that property, you can pretty much ride out
the worst crashes.
The worst crashes, genuinely, around 30%. So if you've got a tenant in there that's covering your mortgage, you can just ride it out. And it's very rare you hear someone that's been really, really put out by property if they've got a good chunk of capital already in it.
I mean, like, interest rates have just shot up, right?
Yeah.
And they've probably gone to the highest point they're going to go in a while. I think it's safe to assume that interest rates are coming down from this point. So mortgages have been about as expensive as they've been in a long time. We've seen in our lifetimes.
And we feel really burnt by it, don't we? Whereas,
but, you know, if you survive that period, you've been through the worst of it in that sense. Now, there could be things in the future that mean interest rates go even higher. But, you know, as long as you can pay the mortgage, no one's come in for the keys. You know, in the main. And I think that's how people need to view it. Yeah. I think people feared the 90s and 08, but they were different. People went into very negative equity, couldn't afford the mortgages, like you said.
And rents weren't, you know, now there's not the same sort of stigma with renting. People long-term rent here. I don't think in the UK, I think we've gone sort of like the European way, where it is, you know, it's more favourable to rent for longer as opposed to just buy. So that's pushed rental prices up amongst other things. So as long as the rent's going up, and they've gone up massively. Oh, yeah. You know, like the past 10 years, it's massive, the rental difference, like doubled, I'd say, when I first started working in Manchester. So yeah, if you can ride that out, it'll come good.
When I moved to Manchester in 2010, I lived in XQ7.
Oh, yeah.
Yeah, well, a building near Salford Quays in Manchester, and a 2-bed flat. They wanted 850 and we got them for 700. 2-bed, city view. Like flat now, I think that thing would be a couple of grand a month.
You're talking a studio now would probably set you back 900, 950 for a studio. One bed's probably 1,200.
But the you know, the demand is there. People are coming in and paying it because the jobs are there. You know, in Manchester's,
and there's a lack of supply. That's one of the main issues you were talking about before, about the number of apartments being built. Say it was 3,000-4,000 units over a space of 3 or 4 years. It barely touches the sides, really, in terms of the growing population and the demand there, the young professionals moving here into the market. So it's when's it going to stop? That how else are they going to control the property prices?
I don't know that it will, because, you know, like long-term trends tend to continue, and people remember when COVID happened and it was like the flee to the country, and everyone's like, oh, city centre's dead. Within 12 months it's back. You know, because companies want you in the office because productivity is better when people are in offices than when they're at home. And people want to live near where they work, and the jobs are in the city. And young people, I wanted to live in the city. When you get to our age, you start to think, well, let's live out the city. But in your 20s, you want to be there, and there's always going to be more 20-year-olds, you know?
So obviously, talking about mortgages there, that leveraging is one of the biggest benefits to property investment. And that's one of really the overriding factors against some of the other assets available. Obviously, it's not quite as popular as it has been recently. We're getting a lot of cash buyers. How strong do you think that leveraging is compared to other strategies that people can do?
You know, I think if you're in the fortunate position to buy cash and you don't need the money for anything else, it's the most powerful tool ever. I mean, you know, when you're younger, it's all about volume. You know, if you can really build a portfolio and then remortgage. I don't think people are educated enough in remortgaging it. You know, get yourself a good mortgage advisor that can talk you through this stuff. It can be more powerful than a financial advisor in some cases, because they can tell you what cash you can pull out.
And you're really in that accumulating stage, aren't you? When you're younger, it's just about trying to build up as quickly as possible.
Yeah, you can't look at it and think, I'm going to quit my job and retire on these 3 properties. It's just not going to work. If you've got that in your mind, it's not going to work. Rents, I don't care who it is, it's not going to happen. But long term, I think that's it. Your expectations needs to be, this is a long term hold and it'll come good. So yeah, leverage is so powerful. I think that's what everybody really should be looking at, and especially since the interest rates are going, only hopefully, fingers crossed, are going down now. Utilise it while it's there. The products are there, whether you're buying a limited company, your own name, it's a lot more flexible now. So as long as you've got the chunk of cash to put in as the deposit, absolutely.
There's been a lot of changes recently to how the government have taxed interest on mortgages, other aspects as well. So some people would argue that it's less attractive than it was. But alternatively, what other options are as viable? What else gives you that security that property does?
Yeah, I feel like, I've toyed with this so many times. Is it even worth it anymore? You only need one big bill, maintenance bill, to come in, or, a bad run of a couple of months to think, is this even worth it? But when you're doing your tax return at the end of the year, you're doing your self-assessment, you work it out, it is worth it. Yeah, it's not hands-off. It's not like, obviously, the investment that Damien's more into. It's really not. And I think you have to go into it with that mindset. But, it's rare that you're going to look at it at the end of the year and think, I've lost a load of money. If you're making money covering your mortgages and it's going up every month, if it's going up in value every year, show me a better investment.
It's that capital appreciation you don't see, isn't it?
Exactly. You've got that tangible asset that, let's say, the rents aren't going great. You could go and visit the property and still think, I've still got this asset. I've still got it. I can see it. I can sell it if I need to. It's there. So yeah, I think the more you can accumulate when you're younger, the better. But I think that goes with any market though, doesn't it?
Yeah, but with the benefit of the property and the leverage is you get all of the upside with a deposit, right? Whereas in the stock market, you can get wiped out because of margin calls. Now, it's worth saying there's still a risk with property. If the property goes down 20%, you're exposed to all of that downside, but long-term property tends to trundle upwards. And, if you put 25k in on a 100k property, it goes up 10% in value, that 10k is yours. So you've made 10k on 25k in. I think that's a better way. It's almost a 50% return than it is a 10% return.
That's where you have to look at it.
Yeah, and I think,
and you can ride out the property price. If you're getting the income there, it's almost like the yield from the dividend. You're getting the return,
and they're
regardless
paying
of
all
what's
the
happening.
Costs. They're paying the interest on the mortgage. They're paying for the maintenance. I think what's probably changed in recent years is that it's gone from you could just buy anything and hope and pray to maybe you just need to be a bit cuter in terms of you need to buy good investments with property. And I think that's where places like this come into play, don't they? In terms of you're looking at investment properties rather than just going, I had a flat but I moved in with my partner and now I still own the flat and it's trebled in price. It's you need to be a bit cuter about it.
It's a different world, yeah, definitely. And I think a lot of the areas where people traditionally have invested over recent years, your London, your South East, your Manchester, where yields can be anything from say 3 to 6% and the capital appreciation's been really, really good. 4.5% interest on your mortgage wipes a lot of that out, doesn't it?
It does.
It takes a huge chunk of it out. So now as the rate starts to fall, inevitably we will start to see prices rise and you'll start to see people coming back into the market. Prices will continue to rise. That demand will be there. So is it now is a good time to get into the market?
I think at any time that people are running away from the market is a good time for you to run at it. I think if people are selling up and saying that it's not worth it and you shouldn't be doing it, I think that's the exact time you get in. Because, if everyone's in it going, it's amazing, the demand is high, the prices are being pushed up, and I think in a couple of years' time, people will be turning around going, oh crap, that was an amazing time to buy.
Should have done it in hindsight, looking back.
And just certain markets, the problem with the 4%, 5%, 6% interest rates were people priced the deal on 1%.
Yeah.
So, it's just changed the dynamics of the deal.
We've been spoiled, haven't we, basically, I think.
But if you're finding deals now at 4 or 5 that work, as rates come down, if they do, they're going to really work. Do you know what I mean? And you could be like, I'm going to lock this in at 2 years now, and it's just going to get better and better and better over time. The mortgage will be paid down by the tenant, and the price will go that way, and your yield's just going to improve long term.
Yeah, my mortgage is coming up for renewal in like 3 months for a 5-year fix. So it was at the lowest it could have possibly been.
You've dodged the worst of it. You're so
I've dodged the
lucky.
worst of it, but still, when I've had like the renewal quotes come through, and you're like, oh, that's not.
You
nice.
did your extension like 2 months before COVID, before prices for everything went crazy,
and then I fixed it for 5 years. I got so lucky. Yeah. But even now, looking at how it's going to go up, you're like, oh, God, I wish I could have just ridden it out for a little.
I didn't even fix my energy bills, so I just got, they were like 600 a month for gas and electric. It was 450 quid a month for gas and electric from 100. So yeah, not lucky.
Every time I spoke to my mortgage advisor in the past like 2 years, I swear I call him the Grim Reaper. He's like, just continuously gives you bad news.
Oh, no.
Yeah, you were on this 2% rate, it's now 6. Do you want to lock it in for 2 years or 5? Neither.
No, 2 months, please. But you'll survive it, and you'll laugh about this, in years to come, and that'll just be a blip in the road of. But some people get shaken up by it, don't they?
Oh, my parents still talk about how they had 13% interest rates. They neglect to mention that the mortgage was like
£1,000.
Less than one year's salary for some people. Yeah, it's like you can ride that a little bit. It's not too bad.
I do think our generation, though, we're more comfortable with finance and leverage, whereas I think the older generation, they aren't, and probably because they're used to times where rates were up to like 13%, whereas it doesn't scare us as much, signing mortgage deeds and things like that.
Well, they didn't really borrow, did they? It was you bought what you could afford. It wasn't a time where credit cards were openly available to everyone. Buy now, pay later wasn't the thing. So it was a completely different
mortgages
world.
were like the late 90s, like Tony Blair and that brought them in. Like they, if you were in the eearly 90s, they didn't really exist in that way. There wasn't that many landlords.
So you bought what you could afford.
You bought what you could afford, and that was it. You weren't thinking, I'll get 10. Do you know what I mean?
Yeah. I think people forget how recent that is. Really, it's a phenomenon over the last 30 years in the UK, where the buy-to-let market has really taken off. And it's changed so much since then. Like we were talking about before, the 100% mortgages, like you couldn't dream of a world now where they go back to 100% mortgages, could you?
No way.
But it's the fine line of how do they then get new first-time buyers onto the ladder, because ultimately they want people to buy their first homes, and they've made the changes like the stamp duty, LISA, giving people a way of saving up money in stocks and shares for a longer time horizon and putting it into the first property or a pension. How else are they going to do it?
Supply side. So there's all that supplement in demand. So they're making it easier for people to buy a property, right? What they probably need to do is just build more properties. We need 3-4 million homes instantly. Every government says they're going to build more, but they never do.
No.
But I think even if they did build loads, it's going to take years, decades to sort that 100%. Out.
Because the problem is they're not going to build in the places that are fashionable, that people want to then move to. They're not going to build in a hub. It's going to be brownfield.
Well, it needs to be affordable. You couldn't go into the centre of Manchester and build an affordable block of apartments because the land cost is so high.
The cost to build, it's all good and well saying we need it, but the actual cost, and we know this because of what we do, but the cost to build, it isn't viable.
No.
And are there enough incentives in place for private developers? And I'm not talking necessarily big developers, your house builders, your Bellway, your Persimmon. I'm talking maybe, say, even the market where someone would buy an old semi-detached house and convert it into 2 apartments. Even that market has changed completely. Less of that is happening because there's not the incentives from developers to do it anymore.
No, you say it'll be out of town, these kind of like developments where all the houses are the same. It's that kind of development that will be pushed, right?
Yep.
And then they'll probably incentivise purchases of those through deposit schemes and things like this. But I think the problems that we have in terms of the housing stock in this country are decades in the making. They're not going to be fixed in 12 months.
No,
they're going to take decades to unwind. And I'm not sure many governments really have the answer, because they're kind of like incentivised to maintain high prices, because many people who vote have their wealth tied up in house prices. So just to destroy the wealth of everyone by going, here's 20 million homes,
dropping the average price over the UK. It's just not going to work.
They're not going to last very long.
They're not going to have many votes, are they? So let's play devil's advocate then. So we've discussed the benefits of the property market and investing in property. Why would you diversify your funds elsewhere in other strategies?
I think So let's say with the stock market, right? I've got my phone here. I've got my whole portfolio on my phone. I can access that anywhere in the world. I can sell it instantly, pretty much. That's pretty valuable. I can wrap it inside of an ISA, which is tax-free. So I could put up to 20 grand a year into that ISA, and it could be worth billions. And I could sell it all in an instant, rip it out, and it's tax-free. So
simple,
flexibility.
Yeah.
Property's kind of like you say, when it's that leverage component to get the wheel spinning.
Definitely.
The stock market's that flexibility kind of, I can be anywhere, do what I want kind of money. And it is, if we're talking, everyone wants passive income, there's no such thing. But if property's like a 6 out of 10 in terms of activity, the stock market in buying a broad index is probably like a 3.
Yeah.
And the 3 is your own emotions dealing with the seeing the swings, because it's going to swing.
Not logging into the app every day.
Exactly. Yeah. It's not very passive if you're checking it 50 times an hour.
No, I need to delete it. I just need to remove it off my phone.
Yeah. So, or you're watching me talk about it every single day.
Oh yeah, it reminds me.
Yeah. So I think it's that flexibility, it's that choice, it's that freedom. If you have multiple assets, you can control when you draw off them, and you might go. Say you get to retirement and you've got 4 buy-to-lets, you've got a pension with £1 million in it, and you've got a stocks and shares ISA with £1 million in it. You might go, I'll draw from my limited company properties up to the dividend threshold. I'll take my pension out to the lower band of tax,
allowance.
and then I'll top up the rest with the ISA. So I'm taking 70 grand a year out of my investments and only paying like a few grand in tax, because you've got that tax efficiency. Whereas if it all has to come out of property or all has to come out of a pension, you're just going to get taxed to the hilt. So whilst it might not be the most efficient way to build, it can be really efficient on the exit in terms of taxation.
Yeah, I think the tax wrappers are a huge benefit to investing outside of property. I mean, we've seen a lot of investors in the last certainly 2 years who are now buying in limited companies that are trying to avoid.
That's a tax wrapper in a way, isn't it?
It's
a tax wrapper for property.
Yeah,
it's
it's a
still
tax wrapper.
you're still taxed, aren't you?
Yeah.
At the end of the day, it's just you're not.
But the
taxing
changes the
back
government are now making in terms of allowances that you can deduct from your expenses, mortgage interest, wear and tear, that's all been clamped down on.
Massive.
Then it moved to short-term lets, and that's happening again. So
Capital
the landscape's always changing.
Yeah,
but for me, like property and so I run a limited company, which is my content businesses, and then I build up cash within that business, and I can't get the money out of the business without being taxed aggressively.
This is what I was just about to ask. Like everything we're talking about is for the future. It's purely for the future. We were talking then. You mentioned having a few buy-to-lets, a pension, drawing down your ISAs, etc. What about, obviously we go back to the passive income, what about now? How do you earn from your investments now?
It's tempting for me to take that cash in the business and put it into property, because I can buy property within the business as like an investment almost, and that can then draw an income. I can produce an income off that. Yeah. So I think it can be tax efficient to buy property. Especially, I think a lot of people listening to this will be limited company directors. Your clients will own their own businesses, and they'll probably have loads of cash in their business. They're thinking, if I rip this out, I'm losing 50% of it. So what do? You can set up like an investment company, lend money from your limited company to that company, and then buy property within that. And as long as you're buying property, you can expense things, and so that's what I'm doing. And that's more attractive than the stock market, really, because if I buy stocks through my limited company, there's no tax wrapper incentive, and I'm also already putting 70 odd K a year into the stock market through pensions and ISAs. So I'm worried about being overexposed there.
Mentioning that, I think something that's very outdated now is the inability to buy residential property in a SIP. Obviously, you mentioned in there about the liabilities to the business. You could buy your commercial premises under your SIP, and that would be.
It was made for doctors and things, so they could own their practices. Yes,
but now the number of people we speak to who have either getting a tax-free lump sum, or they're coming towards the upper limits of their pension threshold and want to put that into property. There's no reason now why they shouldn't be able to do that. Apart from obviously, there would be billions of pounds then transferring into the property market, which would then pushing prices even further. Other than that, that's probably the main reason why they don't want it to happen.
Another reason is the UK finance industry survives off skimming 1% off all the pensions. you know, in terms of
Yeah.
fees. But if you plonk it into your house, it's like no one's getting the money off it. The mortgage advisor might get a little bit, but you've just got this big chunk of cash there. Whereas with all the pension funds, 2 trillion in pension funds, they're just like 1% a year off the top of that. And that's basically what London survives off. You know? So there's probably some incentives there.
Yeah, they're not going to change that anytime soon, are they?
No, they like that fee. I just want to come back to your point, Rebecca, about passive income, because I don't think I answered the question. I think people need to have realistic expectations. So in the stock market, there's this thing called the Trinity study, which says that you can draw about 4% of a portfolio a year, and that would be relatively sustainable. What I mean would the portfolio would last a long time. You're not just going to like bleed it dry.
Yeah.
So if you've got £1 million in the stock market, you can take 40 grand a year off it. So people will come to you and go, I've got 100 grand, I want passive income for life. It's about 4 grand a year, mate, so good luck.
That's what
you get Nando's, Joe, you get a few Nando's. So I think this passive income myth of people think they need to be realistic, and they need quite a lot in the market. So for example, if someone said to you, I want 3-4 grand a month now net in income from a property after everything, you'd be like, you're going to need
about 4 or 5 properties.
Yeah, you're going to need like £1 million worth of property maybe.
Or in cash, sorry.
Or you need like a crazy HMO that's juiced.
Yeah, I mean, some of the stuff, if you get in, say, 10%, which is on the high side, you're looking at, say, 400 or 500 grand.
Still,
and
still 400 or 500 grand. And that might be like student property that you're then never going to see the growth in value on. So you're compromising on one of the main benefits to get that income.
Yeah.
I think passive income is a lovely idea, but I think most people, it's a myth, as in most things are more active. And I also think it requires a lot more money for people to have the lifestyle they want. Because someone who has £500,000 in cash probably lives off more than 3 grand a month. But that's the kind of passive income you're going to get off that amount of cash. Yeah,
that's so true. At the moment, my parents are weighing up selling their portfolio to inevitably put it into bonds, but they'll, because they've done well on the price of the properties, let's say they can pull together like £500,000 and they can get about probably a 5% return on it a year, which is great, and probably not pay any tax on it, which is a great idea for when you're older. But like you said, you need to be realistic. We've all not got you can't get your hands on that level of cash to create that level of passive income that gives us the lifestyle that we want.
Yeah.
And I think it's open to your tolerance to risk as well, isn't it? Obviously, at that point, they don't want to be in a position where they're at risk to the market. Whereas, obviously, at our age, we're probably extremely risky. We're open to the idea of it in terms of putting it into stocks and bonds. But I think our generation is a little bit different. I don't think we'll get to a point where we'll be happy to sit back on the 4% on the bonds. I think we will be more likely to keep a higher percentage into shares than any previous generations. Yeah,
maintain a large position in equity and shares, and then have cash buffers for when the market crashes. I think is a.
You mentioned that in one of your recent videos about having like a couple of years as a cash buffer, and then you can pull from that to top up whenever the years that the market isn't as high as or it's gone down a little bit, and then ride it out until the point where it's higher.
You don't want to kick the portfolio when it's going down. So if you can. Because you put over a long enough timeline, property will dip in price, so will stocks. So if in those moments you can go, I'm not going to draw off my portfolio, I'm just going to use this cash I've got over here to outlast. Because even 2008, it was a couple of years and then off it went.
Oh,
you know, it's like
we talk about exactly that, and it was up and running.
Like 18 months, 2 years,
Correct.
you sidestep the worst of most crises. I mean, COVID when the markets was 2 months and it was like back, you know. But people who needed to dip in at that moment. They kick it while it's down.
I was still queuing at my corner shop, I think, for a wine on a Friday. We were stood in 1 metre long queues waiting, and the market's already come back by the time I got served.
Round the Tesco's extra, just like a snake. God, that's funny to think about that, isn't it?
What about crossing the road? So you were on the same side of the road on a walk.
Oh, your hour you could allocate to go for some exercise.
Yeah, well, I live near Formby and there's like a nice beach there, and you know they said to people you can go out for a 1 hour walk. 10,000 people turned up at Formby Beach, and they were like IDing people as they were going in, and people had come from Leeds on their 1 hour walk, just like driven all the way to Formby.
Crazy time.
Yeah, I kind of miss it. You know, like 10 a.m. Like, should we have a wine? You know,
the Joe Wicks workout that was on every day.
Yeah, Joe Wicks and a wine.
You know what though? People were still buying, weren't they? For us, for us here, like people still. You know, it didn't deter people though. They're still looking for an income because people are still looking for an income.
I remember I worked here when we voted Brexit, and I remember the boss back then being like, if anyone votes it, it's not going to be good for us. You know, we need that positivity in the market, and it will create uncertainty. And I came in the next day and I was ready to like leave. I was like, it's over, like, you know. And I picked up the phone and the guy was like, yeah, I'll buy 2. And it was like, but what? And we did loads of business because people thought, oh, now's a good time because, you know, all the international buyers came in, and also the pound did badly, so it was cheaper. And it was almost like the good times are the bad times, you know, the bad times are the good times, because we don't see the opportunity that presents for other people.
Yeah, it's a really good point. Just going back to your point then we mentioned before about the 4% and pulling it off. Yeah. Do you think that's still valid? Do you think it's outdated?
No, I think it's kind of like a rough kind of rule of thumb to help people understand that what they need is a portfolio that they can draw a portion off.
Yeah.
Because I think most people would think if they had £1 million that they're set for life, when you explain to them that £1 million is 40k a year sustainably for about 20 years, there's a lot of people that think, I need more than 40k to live, you know? So then you're going, okay, well, if you want 80k a year, you need 2 million. And it helps people frame that. I think it needs to be case by case, more nuanced. It depends on your quality of life and your expectations for life. I do think that a lot of people our age have a view of their retirement that won't be sustainable unless they get seriously active about buying assets.
Yeah,
you know, you need to be buying property, you need to be buying stocks, you need to be doing it.
I think if you speak to most people, and if you said to them to live a very, very comfortable retirement, you need, say, £40,000-50,000 a year. And in order to have that, you need, say, 1 to 1.5 million in stocks. I think most just couldn't comprehend that and just think it's impossible to get to. So it's how do you bridge that gap in between? I think the planning aspect of your finances over such a long time horizon is so difficult to do, knowing what you're going to need as part of your pension or to live on when you're 60, 65. It's unfathomable really for a lot of people.
For the longest time in human history, the average male lived to 30, 35. So we're not programmed and women, 50% of them died in childbirth. You know, so we're not programmed to think of 60, and retirement really is 100 odd years old. The Romans retired people, but in the main, retirement came about because of Victorian factories. There was like 70-year-old blokes on the machines slowing them down. They were like, we need to move Terry on because he's so slow. But he was like, I need the money. So they were like, okay, we'll pay you like to leave. These are like pensions. And we had state pension, and for the longest time state pension was enough, and now it's not. People really struggle to think out 30 years, but we also struggle to think about compound interest. You know, we struggle to think that interest on interest on interest and this building effect and this like snowball that builds can take us from nothing to a millionaire in 30 years through just consistent investment. You'll see that with your properties, Rebecca, because in the time I've known you, it was like you had someone you were kind of starting to now it's like...
Yeah, but like you say, just to go back, it still doesn't create the passive income you want.
No.
Sustainable. Like, yeah, maybe when they're all mortgage free, etc., and they've gone up, and who knows, they might sell them all. You know, you don't know. But they don't create that day-to-day passive income that we're all relying on, I think.
No.
That we're all... It isn't attainable.
No, I mean, more people are working into what we consider an older age than ever before. Realistically, will we get a state pension? Who knows? By the time we get there, it's that far away. The goalposts are being moved all the time.
You can't rely on it.
No, exactly. So it's putting other things in place, property, stocks and shares, whatever that you're going to do to make sure that you're in charge of living comfortably.
And I think the main thing is you're not going to break your life by just getting involved. And I think people are so scared. So with the stock market, I see people taking years to stick 100 quid in. And it's like the worst thing that could possibly happen is you lose your £100, you know, and you spend that on like dinner, you know, so just get involved. And I think with property is...
But I don't think anyone's seen a 100% drop of the...
No, that's what I mean. But even I mean, you could in certain companies.
Yeah,
but if
you're buying an index,
if you're buying the global stock market, the S&P 500, it's not gone to zero.
Yeah.
But even if it was, you know, just dip your toe in and get involved. And I think it's probably the same with property of... Don't be thinking, how do I turn 50 grand into a passive income by buying like a care home? Yeah. Just go, I'm going to buy a buy to let and put a family in it. And
I'm just going
to leave it for a few years. And I know that if after 12 months I hate it, I just sell it, you know, and it's okay. And I'll get my money back. You know, worst case.
Yeah, if not more. Yeah. And then building up a portfolio. I think a lot of people want to jump from A to Z and go straight to the finish line. And, this property is going to get me my 20 grand a year and that's it, me done, I can just do it straight away, and it's just not realistic.
But the
Not
internet's
reality.
full of those kind of sexy strategies, isn't it?
Oh,
but if those
awesome.
guys were doing it, and girls,
Social media everywhere, the get rich quick schemes.
Yeah.
I mean, it's like the opposite. I mean, the one that is the two, I either get Dave Ramsey pop up, which is like the complete opposite.
pay off your mortgage before
pay
you
off
leave the house.
So contradictory.
And then other ones, it's like he's like, I don't know, 20% HMOs and get rich quick crypto in and out, and I feel like
Rent
no
to
one ever
rent.
talks about the middle. Like it's always one
A vanilla buy to let with a terrace house has done great.
Or just dollar cost average into the market, putting your £200 in. You just don't
I
see
honestly
it.
feel like this is me. I'm just your vanilla buy-to-let investor. That my expectation is you might get a few £100 a month if you're lucky after your mortgage and all your expenses a month, and that is the reality. That is the reality of owning buy-to-let property, as in your average one anyway.
Yeah.
But I do think there is a pressure now to start financially thinking and planning more than there ever was before.
And it comes back to the education.
And you can't rely on, like Damien said, you can't rely on state pensions the way you probably once could.
Oh yeah, or employer pensions. It's all
Employer
changed, isn't it?
pensions,
So my dad used to work for the prison service and obviously had a pension. Mum was a nurse, a very working class background, and obviously those things just don't exist in the same way that they do anymore. So the DC pensions are now the way forward.
That generation, a lot of them are richer in retirement than they were when they were working.
Yeah.
Whereas, our
So
generation,
true.
it's like, if you want to be like that, you've got to be serious about it.
And you've got to start early.
Yeah.
You've got to start early, and there's
But
the
I think it's worth saying as well, if you've started late, it's not doom and gloom. You just
No.
have to have a higher savings rate. You just have to be like, I'm slamming 30-40% of what I earn into pension. I'm getting aggressive about buying property now,
Or just come back to your point, being realistic. If you're starting at 50 and you want to retire at 60, you're not going to have that standard of living that you're maybe expecting. You might have to work an extra 5-10 years, retire a little bit later, aim for the state pension to top it up, and then you will get to that point. So it's just all comes down to your expectations.
Yeah.
So overall, a bit of everything.
Yeah, just get a little
Not
bit of
eggs in one basket.
Just pick and mix it.
Yeah.
Sit on it for 30 years.
A few couple of balls in.
Yeah, that's it, yeah. Yeah, and have a long time horizon on it where you don't think like it needs to work tomorrow, otherwise I'm screwed. Because all of us sat here right now, we sold Manchester property, say 10 years ago, and I think all of us would say we wish we'd bought a lot more of it.
Yeah, definitely.
Yeah.
Absolutely.
Yeah.